Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you guests that can help us understand more and more all kinds of different ways of generating passive income. And we have a really good, well-aligned guest today. It's Patrick from investonmainstreet.com. Patrick, welcome to the show.
Glad to be here, Axel. Man, talking about stuff I love to talk about. So
yeah, exactly.
Real estate and the same conversation. This can go all day.
Yeah, I know. We have to both contain ourselves to keep it to something manageable. So before we get started into the rabbit holes that we have a high propensity to get into, tell our audience a little bit, how did you get into Invest on Main Street and the stuff that you're doing these days?
Well, like most of your audience, I was a professional out there, successful. I was high paid, high income earning automation and robotics guy. And I was following the traditional path of putting money in the 401k and graduated to things like IRAs and then talked to financial planners. But I got some advice early on, and it was actually the founder of the machine design firm that I work for. And when I was asking him for recommendations, hey, where should I invest these bonus checks coming in? He rightfully so, pivoted me away from the high tech space and traditional investments. And he said his only regret was not investing more in real estate sooner. And I was like, wow.
Yeah, I started 60 years too late.
Wow. Mm-hmm. Yeah. And then he was very encouraging to me and got me down the path of reading the Purple Book, which, from Robert Kiyosaki. And I unfortunately back then I was very eager and inexperienced, and I thought I could go dominate the world. And I got into a pre-development, highly leveraged, right before the 2008 crash. And so my first boom was a quick bust.
Yeah. I understand. I mean, I can very well recall that time, and even before we basically started kind of like in the late 90s, early 2000s. And I believe one of the things that has really fundamentally changed is that nowadays, even if somebody is very inexperienced but eager to learn, the information is out there and relatively easy to get. I mean, I remember like I bought cassette tapes and CD sets and paid for all kinds of workshops and stuff. And it always ended up basically being here's what you need to do, but it didn't really tell me how to do it. So I had to learn over the years all the how-tos myself. I think that would be way easier today. So when you had that not so nice experience, what kept you going?
I turns out I was an engineer, a successful engineer this whole time. So I went through foreclosure, paying out a lot, settled. The bank did debt forgiveness. The government then 1099 me for that. So I was in a pretty deep financial hole as well as the credit hole. I went back into corporate full bore and got a master's in engineering and business. And I was gainfully employed that whole time. But ultimately, when I finished my MBA and engineering master's, I started at a new company to become more of a bigger player in a smaller pool and started making substantial income again. So I needed to figure out where to invest it. And if you follow the breadcrumbs of the wealthy, it leads you back to real estate. I just had to learn how they did it different than how I was. And the fundamentals of building a healthy, diversified portfolio of cash flowing assets. And that was being the tortoise and not the hare.
Yeah, absolutely. I mean, the reason I asked the question is I've interviewed quite a few people and also speak obviously with a lot of people, and it's a little bit this kind of like hot plate syndrome, right? Like where you do something and it totally doesn't work out. Like I know quite a few people who tried crypto and really got burned. And when you ask them today, hey, when do you buy your next fill in the blanks, whatever coin, they basically oftentimes say, no, I'm not going to touch that stuff anymore. So I'm impressed that you said, no, I actually can see the signs. And just because I tried something once doesn't mean that that's the only time that I can ever try it. So,
Well, if I stopped doing things every time I failed, I wouldn't get very far in life, right? There's fundamental differences behind the speculating of new developments and trying to double and triple your money every year than there is buying cash flow existing assets in recession resilient markets. And that's what I learned. I learned
no,
that there was.
absolutely. Yeah, I agree
Mhm,
with you. On the other hand, I think there is some truth to, how it depends a little how bad you've been burned. So,
mhm.
so one of the things I saw on your website, and you mentioned in the pre-show, we want to touch on that a little bit. I got actually curious and would have asked you anyway about the name, because you have something called the Recessionary Acquisitions Fund. Can you tell us a little bit what that is, and how did you come up with the name, and what makes it different?
Well, as we discussed, I became intimately familiar with the downside of downturns
Right,
very early on. And then I became that coming out of that, I grew a humbled appreciation for cycles in the market,
right,
where it not only brought me into real estate, but other alternative investments as well, so that I was a non-correlated. And I believe in diversification. But going through real estate being what I believe to be a healthy 25% of your portfolio, we built a recession resilient portfolio, the 4,000 units, over 4,000 units, 26 required 26 properties, multifamily, workforce housing, got a low leveraged, fixed or rate capped interest, cash flowing, making measurable improvements for reasonable returns. But through the last couple years, we've seen a lot of things change. It's a different kind of recession than we saw before.
right.
While we have the reserves and the debt products to preserve our investors' capital and ride out this recession, right now, today, putting deals together today, what's the best way to operate today? It's not the same way to operate 1 or 2 or 3 years ago.
Totally, yeah.
Because, well, yeah, when I approach my underwriting, my analyst engineer, go to my Excel sheets and start cracking away at deals, and I look at our deal flow, and we have a very unique acquisitions process that goes direct to owner and does a lot of tools we could talk about later, take huge data sets and filter and find what would be distressed operators. We're finding a tremendous amount of opportunity to buy great deals right now, much more so, and to a greater level than we could 3 or 5 years ago, and probably more so than we can in 3 or 5 years from now. But so we, mhm.
Yeah, can you elaborate a little bit, based on your experience, why that is?
Yeah, that's a really good question. Well, let's kind of unwrap this onion, right? So there's so many layers to it. Fundamentally, even if you had fixed interest rate and it was very low leverage and you were cash flow going into this, you hit a financial tsunami, right? Where is the people stopped paying rent during COVID. Rental assistance checks did show up eventually, but that drew and delayed your business plan. Rental assistance checks went away and the eviction ban lifted, but there was backlogs. So right now in places even like Texas, it was 4 to 6 months. Now it's closer to 3 or 4 months. In Atlanta, if there's just an article out that some investors are experiencing 6 months to evict. That means people haven't been paying for years. They never resumed payments.
Right.
So you can only store up so much reserves. We keep 8 months worth in operating reserves. But if anything else happens, it wasn't just the COVID delinquencies that's hit. Insurance has gone up at 30% in Texas on average. It's gone up 50 or more percent in places like Florida. We're seeing similar growth in places like Atlanta, the southeastern states, which are traditionally better to invest in. Taxes have gone up.
Right.
So you sort of layer these on. And then in addition to COVID delinquencies and taxes and insurance, which a watch, right, is only waterproof to a certain depth, right? But eventually it's going to crack. You go deeper and deeper. The next layer deep is interest rates. And while interest rates have gone up, those who did not have fixed interest rates, those who had variable, they've either gone completely underwater because their interest rates in their commercial investments sometimes have gone above 10%, or their income was consumed until their interest rate met a rate cap, an interest rate cap. And that can create $50, $100, $200,000 a month in greater cash drain until you reach that cap. And so you stack all of these things, and the only way out of this is to get in the properties, renovate them, and improve them and get higher rents.
Right.
Well, unfortunately, you can't get the people out because we have an eviction ban. The cost to renovate has gone up because, and the material shortages have driven it taking longer and be more expensive to buy the materials for renovations. The Great Resignation and inflation has caused it to be more expensive to get the labor to renovate.
Right.
And all those combined, meaning it's taking a lot longer. And then the final issue is that most of the bridge debt, not the long-term fix, the bridge debt, the shorter-term 3 to 5 year debt in multifamily is all bank loans, regional bank loans. Regional banks are collapsing right now.
Yeah, they don't want to lend for sure.
And so like you've got like this troubled asset being serviced by this troubled supplier, the regional banks. And the regional banks are saying, hey, even for performing assets, they're saying, nah, we don't want to renew because we're seeing it's more risky now than it was before to invest in your product. And so we're going to decrease our allocation, the slice of pie that we in multifamily.
Yeah,
and so
I'm not so sure. I mean, I don't want to go down that rabbit hole, but I'm not so sure that they always do this completely out of their own freedom of decision making. But if you take the ratio of reserves versus what they can lend, even if they wanted to, that doesn't seem to be very healthy lately either with them anymore. So there's much more scrutiny with the authorities or regulators or whatever you want to call it. The one thing I think that will be helpful, educational for our audience is we are obviously operating, I shouldn't say obviously, we are operating in the small residential, like single family to fourplex arena. Can you just for a moment touch on how the lending products are different for like larger commercial products like what you're working with?
Oh, so your audience is mostly 1 to 4 units?
I think so. I mean, but our whole strategy within Ideal Escrow is to get turnkey properties away from the expensive places that you might be living in to generate cash flow. That doesn't mean that nobody has anything other than that, but you get used to the fact that yes, it's multiple times more expensive than it was, but if you ultimately get a 30-year mortgage, you still have a 30-year mortgage. So this whole point, one thing that I believe, I'm not an expert, that's why we have you, right? But I believe there's also a growing group of people with all those layers that you mentioned about the onion, where they're either already at the point or soon will be at the point where they have to basically renew their lending. And obviously, when the interest rates have grown sevenfold or tenfold or whatever they have grown, depending on when you started, still, I want to get back to the term recessionary acquisitions. Can you give maybe some examples of what would fall into that bucket?
Yeah. So if you look back at like what happened in 2009, people made billions of dollars buying in cash. And so we are finding these opportunities. For example, the last asset we purchased was a software developer in the West Coast owned a property in the Midwest. And we were able to, we reached out to him directly. He was disinterested. He didn't know what he was doing. He inherited the property from his father. He struggled during COVID, and his loan was out of whack for him. He didn't understand it. The property had dropped to 60% occupancy. We had talked to the brokers in the area. They had attempted to communicate with him, but he just wasn't sophisticated enough to turn this property around. So we were able to buy it all in cash. And when we completed our due diligence, we closed within 14 days, which traditionally this is 60 or 90 days. The guy had some other people calling him that wanted to use traditional loans to close, and they were actually higher price, and we were able to get it credible basis. When we bought it, it was what's called a 10 cap. And for what that means is we're basically, because we bought it all in cash, the cap rate is a measure of how much cash flow it pushes off if you buy it all in cash.
Right.
And so we're literally buying it and pushing out 10% a year. But the property was only 60% occupied, which means that other 40% is purely upside. So the effect is,
oh, you only use the 60% for the valuation.
Right. Yeah. So again, in commercial, you value it based on its income for the last
No, I get it.
12 months.
I just realized,
Yeah.
okay, that's actually pretty brilliant.
Yeah. Yeah. So in commercial, you actually go by an actual income. So we had to pull the bank statements. We had to rebuild his P&L. We had to look at his rent roll, and we valued it based on actuals, and which gives us huge upside from a lease up and in a performing property with great anchor tenants, and the ability to get some upside. So not only what we found is that through and I could list like 4 others, and we have the case studies, is that today in today's market, buying in cash, moving quickly, going direct to owner, and picking up these properties at incredible basis is far less risky. And me being the analyst, the mechanical design engineer, I'm doing my analyst, and I'm like, wow, if I just buy this right now, I can get a huge known stepwise growth in my investors' wealth. Now, if I hold it and try and renovate it for 3 to 5 years, that's when my crystal ball gets fuzzy, because I don't know how much capital I put into it, how that's going to correlate to rents and how that's going to correlate to value, because interest rates and cap rates are shifting right now. So
yeah, but I mean, since you're doing it totally without any leverage, you could also be an optimist and say in 3 years interest rates will be at a competitive thing, and I can buy another one with the equity in this one and keep both. You know?
Well, here's the beauty of the strategy, and you as a single family type of mindset will get this more than the multifamily, because in the commercial real estate space, they tend to hold things for long periods of time. Well, the reality is that with recessionary acquisitions, we have a very narrow window.
Right.
We have this. We're just coming off of this time when all these operators are distressed because of all the layers that we packed, and by 2025, they're going to hit a wall. The ones that had these 3 to 5, 5 to 7 year bridge loans,
right,
there's $1.5 trillion in commercial real estate debt coming due by 2025. So we don't want to hold. In fact, if I can buy this, and what we are doing right now is we're refining out half the capital, and then we buy a second asset.
Right.
And then the first property, we immediately work to 1031 exchange into a third property. So the first property became property 2 and 3.
Yeah.
And with each of those, property 2 becomes property 4 and 5. And property 3 becomes 5 and 6. And by that way, you get 1 to 2 and 2 to 4 and 4 to 8. And by moving very swiftly, not doing long-term renovations and not hoping for valuation gain, but by calculating in each step a stepwise growth in our portfolio, and while we're distributing our cash flow, which there's cash flow getting kicked out of these, while we're distributing cash flow, we're not redistributing the refinances and sell proceeds, because we keep reinvesting those. We're going to buy as much as we can in this window, and with this strategy, we can calculate much better what that return is going to be. So it's ability for us to, instead of using your capital in one investment, in one deal, and just letting it sit there for 3 to 5 plus years and missing this whole buying window, our investors can invest one time, and we're going to continue to repurpose it within a fund and put it to work into a dozen acquisitions in 3 to 5 years. And that's how the returns can get very exciting. I mean, if you look at the case studies, in each of them, we've been in the situation where on average, we've doubled our investors' equity in about a year. And so by doing this
if you can get the 40% activated in some way without having to do a massive type of renovation, and maybe do across the board some improvements so you can increase the rent roll a little bit, 50% is probably not hard to do, right? Good opportunity. Now, before we close, one quick thing I wanted to still touch on. I saw that you are using all kinds of different tools to automate and optimize your work, and most of them wouldn't necessarily apply. But tell me a little bit, how does Patrick get help from these available AI tools in your regular life or in your
Yeah,
business?
there's kind of two aspects to it. There's kind of how we run an investment company and stay ahead of the game and find better deals and operate more efficiently. And then there's just any busy professional, right? And
Yeah.
just to from we'll dig further into any busy professional, but just from the real estate side, we use AI like Reonomy, for example, that uses machine learning to aggregate thousands of databases where we can find our investment, we can find off-market deals, the contact information, the loan information, and get intelligence that we otherwise would have taken analysts weeks to do, and we didn't have the reach or the filter. So we have that. We have the ability now. There's AI tools that will take when we get packages from brokers, we have AI tools that will suck them up and then pull out the P&Ls and rent rolls, create it, and use intelligence to do that, which is great. And then we have customized exports that go right into our analyzing models, which saves weeks and allows us to move very, very quickly, analyze more deals. Then we have AI tools which are communicating with our residents, texting, making phone calls. AI is making phone calls, both for scheduling tours, explaining the amenities, people coming in speak to real people. But when they go away, we have AI following up to 10 times on the rental application status, making sure everything's in. Then when they come in, scheduling the dates, scheduling the time to pick up the keys, and then following up monthly with the rent checks. And if it's late, automatically reminding. So it's really cool. And then work orders. It allows our team to be most effective doing one-on-one and doing lease up. And even if we have 20 residents calling at the same time, we can have 100% of those that being heard by an AI and that information aggregated. So there's a lot of stuff there that we do and there's several different tools for all of that. But I guess if your audience is more interested in just sort of like everyday life as a business owner, how we use AI, you go through some of those.
I think the point is, one of the questions that I hear quite frequently, especially when we have new clients joining us, where they say, okay, I already have a busy life with my job and my family and stuff like that, and I want to do investing, but I'm afraid that it's adding even more time to my already busy schedule. And so before we started recording, we talked a little bit about some of the things that can actually give you some of that time back, or maybe make some time available, because stuff can be either higher quality or faster than we used to do it.
Yeah, so I actually am doing a presentation on this, just AI usage for businesses, and I have videos of me actually using different tools to be more efficient. And I can appreciate the time away from family, friends, and hobbies that pushing a real estate career can do. And that I went through that myself. So if you, for example, like if we just pinpointed on some specific stuff, I'm constantly using Google Bard and ChatGPT and exploring it in new ways. I was just recently speaking to a client, and he was asking me questions about tax issues, and he was asking me questions like, hey, I'm buying and selling a property in this location at these times, and I just don't know what my depreciation and capital gains are going to be, and what at the end of the day, how much am I going to have to invest, or if I do a 1031 exchange, what the difference would be. I literally just typed up 2 or 3 lines in the prompt of ChatGPT and said, hey, I need you to be a CPA. I need you to help guide us on this situation. It's an investor in San Francisco, bought a property 10 years ago for $7 million, selling it for $10 million this year. Doesn't know what the capital gains and depreciation recapture was going to be. Do you have any more questions for us to help us? And he's considering doing a 1031 exchange. And it popped out seconds later, 4 questions in which we answered. And then out of that, it gave an entire analysis with the calculations. And then I'll present this live on my AI webinar. But then I said, can you summarize this in a text message so I can text it to him? It did. I copied and pasted it and sent it to a text. And he goes, can you explain it to me? And I said, hey, can you rewrite this in a step-by-step phone script so I can explain the math to him and speak it directly from the script? And instantaneously it did it again.
And then,
So
then you told it in the voice of Patrick Grimes, right?
actually I didn't. That's funny. I should have done that though. But I do always say be very brief because it tends to be very wordy. Um, and but that kind of, and I've done this for dozens of CPA questions, that kind of conversation would have cost me hours and hours, another multiple conversations with a CPA, a follow-up with my colleague. And all of that was done in the span of about 10 minutes within the phone conversation. It's probably saved me $500 in just engaging with a CPA. On a contract side, which this I'm literally using this almost daily now. I had a supplier that wanted a $15,000 advance on his payment, and so I had a contractor agreement already in place. So I basically said, this is a contractor agreement I have in place with this guy, and I pasted it in. And then I said, what I want to do is have you create an addendum to this contract, which, and I can step through this, but that allows for me to prepay him $15,000, but I want to make sure that there's penalties for him not repaying it, that he has to work in good faith to make good on it. And I just made it real vague and I hit enter. It created an addendum to the contract in perfect condition that had a 12% simple interest on that unless he pays it back. And he had 12% simple interest on it moving forward. It had a good faith of working, and it had the entire contract with all the conditions to be an amendment. And I said, okay, well, I want to forgive the interest if he pays it back in 6 months. And then it modified the contract with that. And then I said, I only want to pay him $5,000 a month installments. And then it modified the contract with that. And then I said, you know what? This is great, but I want this to become a debt to him personally if he doesn't pay it off. And I want not his business. I want him to personally guarantee this. And I want for, anyways, I hit that, and it was just every single change it made. And I said, I want good faith to be defined as 20 hours a week, and he would need to provide logs of those hours to work in good faith to work it off. And then it did it again. It was in all the span about 14 minutes. And because of these contracts, which are like for these relatively small amounts, would cost $2,000 for an attorney to put together or modify, create, that I was able to literally hit, because I did this using Google Bard, and it always creates 4 versions you can choose from each time you ask. I was able to hit export to Google Sheets, and then I shared it with my attorney, and I said, is there anything that needs to be added to this? And he goes, no, you're good to go.
Yeah, I mean, one thing since you mentioned both, have you found in your experience using both, the one is better, like GPT and Bard, one is better for this and one is better for that in your experience?
No, I think that they both have their strengths, and they both have their weaknesses. ChatGPT, for example, I think Google Bard's stronger at contracts, especially because it's integrated with the Google Sheets, so it's much more adaptable.
Right.
You can export things. ChatGPT is really great at, like yesterday, I pasted in a paragraph that was a fee schedule for one of the for an insurance claim, and it was like, if it's this amount of money, then it's this percentage, and if it's that amount of money above that, it's this percentage. And it was just the agreement in the contract. And I said, here's the agreement in the contract. Can you create a spreadsheet with progress payments, which allows for me to plug in progress payments, and then it creates like that bracketed payment schedules that I pay to this contractor. And I hit enter, and it did it up to 3 progress payments. And it gave me all the equations, and I said, can you push it to 5? And it created it to 5. And then just a matter of 5 minutes, I was able to create what I could have done it myself. And I'm an engineer, I'm an analyst, but having it done by ChatGPT was so fast and efficient. And then I spent my time just making sure it was right.
Yeah,
And I
absolutely.
literally endless, and because I pasted it in just the contract as is. That's how it's the journey of trying to become like, because I started rewriting the contract and micromanaging it of what I wanted it to do. And then I was like, wait a minute, let me just try pasting it in and saying, can you create a spreadsheet to calculate the fee? Just that simple.
Yeah,
And it did it.
those are great examples, Patrick, and thank you for sharing them. One thing that I'm trying to get across is that, like you were kind of hinting softly towards, is that we have, at least in my work life, always assumed and always also being required to pay for specialized expertise, whether it's you need a CPA to do, your business filings and your personal tax filings, you need an accountant for the calculations, a lawyer for this, you need, like all kinds
Yes.
of
Mhm.
experts. And I want to remind our audience, and anybody is more than welcome to confirm that or research it yourself. But these tools, whether it's Bard or ChatGPT or the integration into Bing or some of the other ones even, they all have basically been challenged because I guess people are sometimes fun like that to say, okay, I want to see if this thing can make the bar exam, or I want to see if this thing can go through the CPA accreditation of the state of California or any of those kind of things. And pretty much by now they all pass almost all these exams without any problem, right? You just give them the exam and
Yep.
so for me, because sometimes in the beginning people were saying, yeah, but how do I trust this thing? And basically, yes, a lawyer that you're hiring has the exam passed plus X amount of years of experience, but typically doesn't have the ability to keep everything that's ever been written about this stuff in their brain
Mm-hmm.
available in 15 seconds to you, right? So I think there's a fair balance. I'm not saying I'm completely convinced it will be everything for everybody and all these specialists will disappear, but to have them and to check in and to get help on that level of sophistication, I think it's just fascinating, and we're only just really scratching the surface right now.
Yeah, and I want to say that it's still important that you do this step of, hey, Mr. CPA and attorney, can you confirm this? Or, hey, Mr. Investor, please run this by your CPA. But it's much cheaper, if not free, to have that quality audit done on something that's already been created. And to your point, when I do research on legal matters, or I do I've even said, hey, here's a paragraph. Can you add an additional paragraph that explains this other aspect, and please cite your sources for the legal basis? It'll actually give you the sources for the legal basis. Having that research done and say, hey, attorney, does this look right to you? It is so much more efficient and faster, right? For everything. And I mean, I could go on and on and on
Yeah,
with
absolutely. I'm with
other
you.
stuff.
I'm pretty sure there will be a level in the not too distant future where there will be some certain level of what we would otherwise call a certification, right? Because I think there is currently still some uncertainty where people say, yeah, right, but is it really looking in the right information at the right context, and could it be wrong, and then
Mm-hmm.
you're in trouble and stuff. But I don't think it's very far-fetched that sooner or later somebody will come up with tools that actually validate the approach, not really the content,
Mm-hmm.
but the approach. So you can say, okay, if you use it in this feature, in this function, for those kind of things, you can be 99% sure, and that's probably as good as you will ever get with anybody, even with an expert, that what you get out of it is usable.
And you can actually say that to ChatGPT. You can say, and Google Bard, only use credible sources in which you're absolutely certain are reputable, and it will only go to like the highest journals and the high.
Right.
But they do have hallucinations.
Yeah, I
Whereas
know.
because I type things in and I'm like, okay, something got mixed up in the neural network, and I think it's kind of fun. It's kind of a journey, right? Um, and then they do some. I mean, they have the ability to cite fake news and propagate false narratives. So, like I said, I it is. But then again, if I Google, I have the ability to find fake news, and I
Yeah.
have the ability to follow false narratives. But I think the reality is that the efficiency behind which it can create the information that can be quality checked and controlled, that can be reviewed by more intelligent humans, right? that at present that are more intelligent, I think is just out of this world. I highly recommend people use it. And if, I'm doing a webinar and a replay of it, investonmainstreet.com if you want. And I go through all this stuff.
Yeah, that would be exciting. So now that we have cleared that up, how can people get in touch with you if they want to do the recessionary acquisition fund or something like that?
Yeah. If you want to jump in and be a part of us generating substantial wealth at a very narrow window of time when we can just do this very quickly, jump on board. Investonmainstreet.com is our website. Investonmain and then street.com. We also have Passive Investing Mastery, passiveinvestingmastery.com. And on Passive Investing Mastery, we're launching a bunch of panels on alternative investing strategies, all passive. And we just had one on car washes, on storage, on laundromats and ATM machines, and like all kinds of. And we also do diversified energy funds here with oil and gas. And so the way to build out that diversified portfolio of real estate's 25%, high income and ultra wealthier at 25 to 50% in alt assets of their portfolio. So learning how to do that and invest in downturns and in recessions is what we're all about. If you want to jump on board, come on over, opt in. You'll get a bunch of great content. We love what we do. I also offer a free copy of a best-selling book just as a give back. I did it. Phil Collin, lead guitarist of Def Leppard, did a chapter with me. Brian Tracy did the forward. That was an actual rock star, by the way. And so, yeah, we had NFL, NBA players. And so we each did a chapter. So many just awesome stories. It was such a fun project. Did make a bestseller. I bought a boatload of them and I sign them and send them off just to help inspire people. It's persistence, pivots, and game changers, turning challenges into opportunities. And I tell my whole story from the battle between high tech and real estate and my ups and downs and twists and turns along the ways and how I made it out of the rat race. And so I'm here in Hawaii, and I see your backgrounds are very similar. I'm actually in Waikiki right now. So
yeah, I'm not too far away from the beach. It's not really a window, but I'm not very far from it. What's the link to get to the book?
Yeah, invest on main and then street.com/book. And if you put the name of this podcast, that'd be your promo code. Well, what promo code do you want to use?
Well, you can use IDEAL.
Okay. Make sure you use that because we don't send out free copies signed to everybody. So make sure you put that in the promo code, and I'll look forward to it. And if you want to chat, I've got time on my calendar every week. I'm not infinitely available, but I carve out time to help to meet with people. It's one of the things I love doing now that I don't do engineering anymore, and help get people pointed in the right direction for whatever their goals are.
Yeah, that's wonderful, and thank you for making the time, Patrick, for today. And maybe we do it again and talk about diversification a little more.
Awesome. Thank you so much, Axel.
Yeah, thank you.